Welcome to the ultimate guide for maximizing your profits in 2025, which I think is going to be a volatile year. Whether you're a seasoned option trader or a beginner, stay tuned. We've got something for you. In the next few minutes, you're going to learn how to maximize your profits and reduce your risk in a volatile market. And we're going to show you exactly how to do it with the best strategy on the option trading platform. I'll show you how to adapt this strategy as market conditions change in 2025. So if you're ready to take your option trading game to the next level, be sure and hit that like and subscribe button down below and download the free options workshop. It talks about the two main benefits of trading options over buying stocks. As we look ahead to 2025, there's a mix of opportunities as well as challenges. Continued growth, but at a slower pace, is what some people are thinking. The S&P 500 has shown remarkable resilience and growth in recent years, surging about 80% since 2019. So a lot of analysts are projecting a modest pace moving ahead for 2025. Bankrate's Market Maven survey projects the S&P to be around 5975 by the end of third quarter 2025. That's only a 4% increase from September 2024 levels. The projected growth rate is below the long-term average of 10%, suggesting a period of more tempered expectations. I personally think it's going to grow much faster than that, and we're going to have a bigger surge in the stock market next year in 2025. However, we will see. Market concentration and the Magnificent Seven is another key factor. A significant trend to watch is the increasing concentration of market value in a small number of companies. Now, this is Apple, Amazon, Alphabet, Meta, Microsoft, and Nvidia. These are expected to continue to outpace the broader market with forecast earnings growth of 18% compared to 14% for the other 493 companies in the S&P 500. I did leave out Tesla. Potential for volatility. While growth is expected, there's several factors that can contribute to market volatility in 2025. There's the interest rate environment, and there's valuation concerns, geopolitical factors, as well as the U.S. presidential election aftermath. And as far as sector performance, technology and growth stocks, particularly the Magnificent Seven, are expected to continue driving much of the market performance. Value stocks may present opportunities, with some analysts predicting they could outperform growth stocks over the coming years. The long-term outlook suggests moderate growth and long-term mixed performance. 42% of analysts surveyed expect returns over the next 5 years to be lower than the long-term averages. 33% predict returns in line with averages and 25% above average returns. Before we dive into our advanced strategy, let's review the fundamental concepts of option trading. Call and put options. Call options give you the right to buy at a specific price. Put options give you the right to sell at a specific price. The strike price is the price at which the option can be exercised. The expiration date is the date when the option contract becomes void. Premium is the price that you pay to buy an option contract. It's also the credit you receive when you sell an option contract. In the money versus out of the money. In the money means the option has intrinsic value. Out of the money, the option has no intrinsic value, only time value. And finally, implied volatility, the market's forecast of likely movement in a security's price is what implied volatility is. Now that we've reviewed the basics or fundamentals of option trading, let's dig into our advanced strategy, selling Iron Condors. Now, Iron Condors benefit from time decay as well as decreases in implied volatility. Here's how it works. We sell an out-of-the-money put credit spread, and we sell an out-of-the-money call credit spread. Both spreads should have the same expiration date. Selling Iron Condors is ideal for volatile markets because it profits when the stock is staying within a specific range. It benefits from time decay, and it can profit from a decrease in implied volatility. The key considerations are choosing your short strikes based on the expected stock movement and desired probability of profit. We want to aim for around 1/3 the width of our spreads. Monitor the position and be prepared to adjust if the stock moves close to one of your short strikes. All right, guys, this is one of my favorite trades right now, the Iron Condor in the Qs, which is the NASDAQ 100. And if we go on the Tasty Trade platform, there's a link down below. Check out the link. There's benefits if you open an account through the link. And I also use Moomoo, so check that one out as well. They're both great for options trading. We punch in QQQ right up here in the upper left, and we make sure that we're on the trade page right here, and we're on the table mode. And then I like to go 30 to 45 days to expiration. So at 33 DTE, we'll click and open this option chain, which is the December 2024 chain. Now there's also daily options. We're in regular options. They have more volume. You can see 51 million shares are traded. All expirations, you can see every day, every other day, the Qs are traded. So extremely liquid. So that means that we don't lose much between the bid and the ask spread and give away money. So easy to get in and out of. So let's open up this December 2024 option chain. And we've got puts on the right, calls on the left. So we're trading at 496. Our IVR is 19. So like we mentioned, IVR is pretty high. That's pretty good for the Qs for an ETF because the risk is spread out over a lot of different stocks. And it pays good premium when the IVR is high. So we're trading at 496, so basically 500. Let's go $20. Look at $20 to the downside and $20 to the upside for a short strike. So on the put side, we'll sell the 480, and that's, look, 70% probability of profit that we're going to be in that profit range. And you go to curve mode, you can actually see that right here. Here's the profit range. Here's where the stock's trading. It could actually go down. You still make a profit. So 480, and then we're going to, as safety, we're going to buy the 470. So this is the put credit spread. We collect $1.70. So that each contract controls 100 shares of stock. So that's really $170. Our max loss is $830. It's the width of the spread minus the credit collected. And again, our probability of profit right here, you can see, is 72%. So now let's look at the call side. We're going to sell a call credit spread and collect premium on the call side as well. Let's look out at the 520. We'll click on the sell on the call side to sell the 520 call. And then for protection to the upside, we'll buy the 530. So now we're at $328 collected. As soon as we hit review and send and place this trade, just to make it clean, I'm going to go 330 and try to get filled. But you can see these are 10 cent wide, so not a lot lost between the bid and the ask spread. We hit review and send and place the trade. We can go to the curve mode and we see that we are profitable and keep that $330 that's deposited in our account when we place the trade, as long as at the end of the 33 days when these options expire, we are in between that 480 and 520 short strike prices. If we hit analysis mode here, you can actually see where we even are profitable a little bit further down on each side, and that's because we're collecting the $330 up front. So again, review and send and place the trade. Let's take a look at managing risk and maximizing profits. Optimal entry timing. Enter the trade when implied volatility is high but expected to decrease. This allows you to collect more premium up front. As far as the width selection, we aim to collect about 1/3 the width of the spreads in premium. And taking early profits, we want to close the position when we reach around 50% of the max profit potential. This can increase our win rate quite a bit. And then we roll the untested side, and that's the profitable side, closer to the current price to collect additional premium. We also manage the expiration risk. We don't wait until the expiration of one of the strikes, well, they're the same expiration date, but we don't want to wait and roll at the last minute. We want to roll around 10 to 15 days to expiration. We want to leverage our volatility skew and take advantage and put these Iron Condors on in very high volatility and then take them off in lower volatility. And then we can also adjust for directionality. So if we've got a slight directional bias, we can consider making the Iron Condor slightly skewed by adjusting the width or the positioning of one of the spreads. The most important thing that we can do in reacting to market shifts is to not be too big. We always want to have some money on the sidelines ready to invest should there be a big market shift. So I would say stay small and have money on the side ready to go. The other thing is if there's earnings announcements for companies, we know when those are coming out. So you may want to be in the trade or out of the trade, depending on the position and how it's performed in previous earnings cycles. Now, IVR is high during earnings, right before earnings, and then collapses right after. So sometimes that can be great for Iron Condors. And lastly, interest rates. Fed Jerome Powell. We know the dates that he's going to go out and make those interest rate announcements, whether there's going to be a cut or not. And we can either be in or out of the trade at that time. So monitor that as well. All right, guys, there you have it. The ultimate guide to Iron Condors in 2025, which I think is going to be a volatile period. All right, let me know your thoughts in the comments below. Ask a question. I answer every one. Remember to hit like and subscribe. Download the free options workshop. Join Tasty Trade or Moo or both. And thanks for watching. I'll see you in the next video.